Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about two different strategies when people are looking at their investment portfolios. We hear this quite often in the news, and we also use the terminology when we talk to our clients. And that's a buy and hold strategy and also an actively trading or an actively managed strategy. So we're going to look at both of them, find out, what is better for people out there, whether it's based on age, whether it's based on risk or time horizon. So the first thing we're going to look at is a buy and hold strategy. Now, this is something that people have heard about for years. Many people refer to Warren Buffett when they talk about a buy and hold strategy. And I think one of the most famous lines Warren has used in the past is people ask what is his time horizon for most investments when he buys. And he said life. I mean, he wants to buy for life. And typically he buys and holds for a significant period of time. However, that's not in exclusivity. Understand that Warren Buffett and his firm, also do some very active management and trading also. So, I mean, it's not exclusively one way or another. Many times it's a combination. But we're going to look at buy and hold strategy first. And also, I heard a couple years back, and it's sort of a good rule of thumb, but it's not exclusive. And that is, buy and hold strategy is something you typically go through when you're younger, and it's a great way to accumulate wealth. Tyler and I tell our clients we would love to see them, put 15% into their savings and retirement plan every year, more if possible, of course. And many times when we're younger, it's a buy and hold strategy. You're accumulating wealth. As you get older and you look at actively managing the portfolio, in other words, you are picking up certain trends and selling positions, you're looking at sectors, you're looking at geopolitical issues, you're moving things in and out of the portfolio, maybe based on seasonality, such as retail and so on. So many people refer to active management as managing the wealth. So buy and hold strategy, accumulating wealth, active management, managing wealth. Tyler, let's talk a little bit deeper about the buy and hold strategy and who are good people for it.
Yeah, Dean. So first we're going to explain each, starting with the buy and hold. A buy and hold strategy, it consists of buying stocks, ETFs, or mutual funds and holding onto those for long periods of time, just like the name implies, a buy and hold. So you buy into an investment and then you hold it over a long period of time. Now, with a buy and hold strategy, you're definitely going to have short-term fluctuations where you buy into an investment and over the short time, it's going to fluctuate. If the market's volatile, your account will probably be volatile. Just for example, in we're about midway through 2019, and in late 2018, there was a 3-month period where the stock market lost about 20%. And if you are executing a buy and hold strategy, you're holding on during that time period, but that 20% decline took place in 3 months and it's come back since then. So again, there's going to be short-term fluctuations with a buy and hold strategy. So first off, you want to understand that you're buying and holding an investment, but over the short term, it's definitely subject to that fluctuation. Now, over the long term, historically, the stock market has risen over time. So that's the whole concept of a buy and hold, where it's not really about timing or trying to time the market, but it's about time in the market. So if you buy into an investment and you hold it over a long time period, your chances are likely that you're going to make money in that investment. So the whole concept behind buy and hold is that historically over time, the stock market has risen, and therefore your account value will as well, as long as you hold it for a long enough time, a time period. Now, another thing with buy and hold is that it does help, to an extent, it helps minimize fees. And here's why. With a buy and hold, you're buying onto an investment, you're holding it for a long period of time, so you won't really incur different trading costs. And what I mean by that is typically, depending on where your money is held, every time you buy or sell a certain investment, you might have to pay a commission or a fee. So if you're constantly trying to trade and buy and sell different investments in the short term, then you're going to pay those transaction fees, and those could potentially add up over time. So buying and holding on to an investment helps you really minimize the cost of trading fees. Another thing is a term called turnover. And what turnover is if you're, if you're not buying and holding, but if you're buying and selling, every time you sell off an investment, you're turning it over, you're adding something new into it. And what that does, depending on how the account is titled, and what I mean by that is if you have any type of non-retirement account, so we talk about non-qualified accounts often on our show, and if you're holding your investments in a non-qualified account and you're continually trading those, you're buying and selling, every time you sell at a gain, you incur taxes. It's a potentially taxable event. So if you're constantly selling off different investments, then you're incurring a taxable gain potentially. So if you buy and hold, you're not selling as often, so it's going to be less. There's going to be less taxes that you incur. So it's typically more tax efficient than an actively managed portfolio, which is another pro of the buy and hold strategy. But one thing that's very important to mention that many people don't understand is that it's called buy and hold. It's not called buy and forget. There's many people that think of it where you buy into certain investments and then you just forget.
Okay, Tyler, you bring up a really good point here, buy and forget. Tyler and I met with somebody a couple of weeks ago. He and his wife came into the office to see if they'd like to work with us. They were talking to us. We were exchanging ideas and giving them a second opinion on their current portfolio. And at one point, we looked at the statement of a 401k, and he was very quick to tell us that he likes to just buy and hold. I mean, just accumulating wealth, which is a good idea while you're working. But through 2008, when the market turned down, he turned most of his portfolio to a money market or a cash position, and never converted back out of that. So he missed a big, significant part of market growth that we saw here most recently, only because, yes, he did do the right thing by just continuing to dollar cost average into that account when the market was going down, because he was relatively young and could make it through that market down cycle. But again, moved most of his investments to a cash position. Buy and forget was his motto instead of a buy and hold, and unfortunately didn't realize at all some of these significant gains that most people saw over the last 10 years.
Yeah, good point there, Dean. So again, really important to continue to monitor. You don't just buy and forget. You want to buy, but then you hold and you still monitor. And one thing that you must do is something called rebalancing, and that is where, for example, you might buy into two different funds at 50% each. But then over the course of a couple years, if you don't pay attention to it, one fund could be at 75% and the other could be at 25%, because the one that's lagging behind, you would then have a lower percentage. So that could dip down to 25%, and then your allocations could be way off and way out of whack. So you always want to go in at least annually and try and rebalance and make sure your allocations are in line over time, because once they get out of line, you might be either too aggressive for what your risk is or too conservative, depending on which investments appreciate more than the others. The other thing with buy and hold is that it prevents something called market timing and helps you to invest for the long term. But if you let your emotions get the best of you and you make any type of knee-jerk reaction during a big market downturn like we had in late 2018, and you sell at the wrong time, then you could really deviate from the strategy. And it doesn't really work well if you think you're too emotional with your investing decisions. Meaning, if there's a short-term downturn and you can't handle it and you sell at the wrong time, then you're doing the exact opposite of what you want to do, which is selling at a low. You always want to sell at a high. So buying and holding, or a buy and hold strategy, does prevent market timing, where you're not trying to time the market. But at the same time, if you can't hold on during short-term market fluctuations, then it's probably not a good plan for you, because then you're probably too emotional and you want something that's a little more hands-on. So keep that in mind. But buy and hold strategy consists of buying and holding stocks, ETFs, or mutual funds over the long term.
Okay, good points, Tyler. Now we're going to talk about active management. Our firm here does both strategies depending on, again, the age of the client, the risk tolerance, what they'd like to achieve in retirement, their time horizon, all of the basic things you have to look at when you're looking to invest. But the bottom line is we believe you need to be very short-term aware of what's going on, but you need to be long-term focused. And what I mean by that is we still believe in investing for the long term, but that doesn't mean you just shut everything off. As Tyler said earlier, buy and forget is not a strategy. Okay, a buy and hold is. But let's talk about active management. Active management really takes into account certain things like sectors that are going into favor or out of favor. So for instance, we'll have people say, well, they want to buy this particular stock in a portfolio. What do we think of it? And we say, well, it's a good company, it's a good stock, but it might be in a very poor performing sector. Typically, you are not going to see a very good performing stock that is in a sector that's not performing well. So you have to look at things like that. Also, when it comes to active management, you look at momentum. Too many people think that you need to buy investments at a low. Whether it's a 52-week low, an all-time low, they think that is always the best opportunity. Well, when you're actively managing and you're moving investments in and out of a portfolio, yes, you have to look at that, but sometimes these investments are low for a reason. And I've seen people who purchased investments at a low thinking that they're doing the right thing, only to find out that they stayed at a low for a significant period of time, a year or two. So things when it comes to active management, you also look at momentum of the individual investment. So for instance, you look at things like Amazon and Apple and Microsoft and investments like that. And I'm still looking at large cap, investments and not making a recommendation. But if you looked at buying at a low of these three investments over time, chances are you wouldn't hold them in your portfolio. They're constantly year in and year out, increasing and growing. So as a result, there are times where you want to go into actively managing a portfolio and getting some momentum investments or momentum stocks. If a tech sector is taking off for a certain reason, there are chances that you could probably get in there and pick up some gains on some significant momentum. Momentum can also go the other way. So for instance, right now in 2019, we're dealing with tariffs and they are affecting certain stocks in certain sectors. So momentum can go down significantly in a certain sector, even though the stocks had been performing wonderfully prior to that time. So again, active management also takes into account geopolitical issues. You need to be aware of that. Buy and hold strategy, great for accumulating wealth. Active management, actively trading, many times is a great way to manage wealth. So we look at it from a standpoint of pre-retirees and retirees. There's going to be a phenomena that comes up for everybody at one time or another. It's called, no more payroll. That's what retirement's all about. So your investments need to stand on their own 2 feet because no more money is going to come into the account to take it out of a market trough like what happens with a buy and hold strategy. So if you're looking at active management, no more money's coming into the portfolio. Therefore, there's no reason to hold certain sectors, certain investments if you don't see on the short-term horizon that there's going to be an increase. But always be long-term aware. We're still looking at investing for the future. We are not timing the market. Many times we're taking gains off the table to reinvest in something else. Active management also means taking dividends and having the dividends, instead of going back into the stock or the investments that created them, the dividends go into a cash position so you can look at buying more and different investments in the portfolio. So it's helping diversification. Tyler, what else should we talk about when we're talking active management?
Yeah, so again, when we talked about the buy and hold strategy, that was buying into an investment and holding it over the long term, whereas an actively managed investment strategy consists of buying and selling your stocks, bonds, ETFs, mutual funds based on fluctuations in the stock market and the overall economy. So you could buy into one thing and a year and a half later you could sell it off depending on the overall stock market or the overall economy. Now, keep in mind, like you said, Dean, we really want to reiterate that it's not market timing or any type of short-term trading. What we're doing is we're looking at the market over the long term, and if we see something in the future that would indicate that the stock market could be heading downward or the economy's not doing well, then we're going to make a decision. So really, actively managed portfolios, they try to minimize the catastrophic market downturns like in 2008 and really try and smooth out the ride a little bit for investors. And as you mentioned, Dean, it works really well for pre-retirees and retirees, which is something that we're going to get into in a little bit here. But ultimately, actively managed portfolios, they try to avoid catastrophic market downturns and extreme short-term fluctuations, but you also try and capitalize on long-term market appreciation as well. So it's more selling as opposed to a buy and hold, and usually you will transition from a buy and hold to an actively managed portfolio as you get older and as you head into retirement.
Good points. That's a good point. So you don't have to be a buy and hold investor or an active managed. You can be both. It depends on what stage of the life you're in. Again, risk tolerance, time horizon, and so on. Before we go on, we're going to take a quick break, though.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, now we're going to talk about, who does the buy and hold strategy work for? So, we talked about what a buy and hold strategy is. Again, rule of thumb, to accumulate wealth. So who does it really help? Well, it's going to be obvious that when people are younger, when they buy and accumulate wealth and hold, they're going to be significantly better off than if they try to actively trade. The numbers are against you. Tyler, let's talk a little bit about our, 20s, 30s, 40s, and when we should look at buy and hold versus maybe converting to active management.
Yeah, no, it's important to note that both of these strategies, both buy and hold and an actively managed strategy, both can work for anyone. But buy and hold is typically seen with many younger investors, especially within their retirement accounts. And the reason being is that when you're younger, you have a longer time horizon and you can afford to take more risks. So you can buy and hold investments over the long term and not be as worried about short-term market fluctuations. Another reason why is in retirement accounts, in your 401k, 403b, your IRAs, you can't even touch them without penalty until 59 and a half. So, if you're in your 20s, 30s, even 40s, you're probably, if your main goal is to try and maximize long-term growth potential, then you're probably better off by buying into and holding different good performing growth stock mutual funds or individual stocks or ETFs within your retirement accounts, because again, you have a long-term time horizon. You shouldn't be too concerned about short-term market fluctuations. So again, usually the younger you are, the better for a buy and hold strategy. One place where a buy and hold strategy typically isn't recommended would be if you need access to funds in the short term. So if you have money set aside in checking or savings in the bank and you want it to make a higher return than what it's making in savings right now, some people come in and they say, should I invest it in different stocks, mutual funds, ETFs if I want to use it in 5 years? Well, probably not. You probably don't want to buy into a stock or a mutual fund and hold that for 3 to 5 years if you plan on using it in the short term, because again, short-term market fluctuations happen all the time, and the last thing you want to do is take $10,000 invested in the market and then 3 years later when you need it, have that money be down to $8,000. So again, buy and hold is usually recommended over the long term, especially within retirement accounts. But again, buy and hold strategies can work for people who are older because you can put aside, or you can set aside a portion of money, not have it all in a buy and hold strategy, and it'll work for you if you're older as long as you can tolerate short-term market fluctuations and have a higher tolerance for risk. The other thing, in addition to that, the S&P 500. So when people refer to the stock market, many of them refer to the S&P 500. That's 500 large U.S. companies that represents about 80% of the overall market. S&P 500 has averaged right around a 10% rate of return since it originally began back in the 1920s. But keep in mind, that doesn't come without some major short-term market fluctuations that you have to be able to withstand. So if you can buy into different growth-oriented mutual funds, stocks, or ETFs, over the long term, you can typically average a good rate of return, but keep in mind, if you're not able to handle that risk, then it's probably not a good idea for you. In addition to that, with a buy and hold strategy, you can also throw in some different bond funds as well, and you won't have as much overall market volatility as the stock market as a whole, which can be nice for some people who are older or in retirement who also want to implement a buy and hold strategy. So ultimately, when it comes to buy and hold strategies, who do they work best for? Usually we see them with younger investors who have a longer term time horizon. They might be in their 20s, 30s, or 40s, and especially within retirement accounts where, again, they can't touch the money until 59 and a half anyway, so they want to really try and maximize growth. Usually at that time, you want to buy and hold different growth-oriented investments over the long term.
Right. And I guess just in summary, too, remember, if you become very emotional over short-term fluctuations, a buy and hold strategy might give you an ulcer, okay? I mean, because you're hanging on to it. And the other thing, too, is remember, over time, a buy and hold strategy is going to create significant investments that become out of balance. So you still have to rebalance these portfolios and bring them back in line. Otherwise, you're going to be carrying certain investments in your portfolio that had significant gains. They're going to become the lion's share percentage-wise of the portfolio. And if that particular sector then becomes out of favor or is hit hard, your portfolio is probably going to carry significantly more risk than you thought it was going to. So you still need to rebalance. Buy and hold strategies can become out of balance over time. Okay, let's look at who does actively manage strategies work for. Again, we talked a little bit, Tyler and I, about the possibility as you start getting older and knowing that there's going to be a time that no more money is going into these investments, whether it's your 401k or 403b or an IRA, non-qualified account, whatever it is, you need to look at these investments and say, okay, how do I continue to grow them but manage them against maybe some short-term fluctuations but still stay invested for the long haul? So that's where you want to look at some actively managed strategies when you go into this. So again, an example here in 2019, many of the international positions are out of favor, and a lot of that has to do with some trade disputes that are going on. And it's silly to a certain degree to carry significant amounts of those positions in your portfolio if there's so much risk over it and they have suffered so much percentage-wise as far as, a dip in the market. Actively managed portfolios then would pare back in situations like that based on geopolitical issues that are happening out there. And then once a trade deal goes in place or things subside and we start to see some growth, an active managed portfolio or manager will then go back into those areas to take advantage of some of the momentum. So Tyler, let's talk about some more specifics on who would be a good person to have an active managed portfolio.
Yeah, so when it comes to actively managed portfolios, they tend to be used most for pre-retirees and retirees. So people who are within 3, 5, 10 years of retirement or heading into retirement and in retirement. Reason being is that they usually won't have as long of a time horizon. And in addition to that, as opposed to when they're working, they're no longer able to put money away into their account. Now they're taking the money out of their account. They flip their switch the other way, and instead of contributing, now they're withdrawing the money to live off of in retirement. So that's when you want to really try and minimize the catastrophic market downturns, and you can't afford to take on the risk you once did when you were younger within your 401k. So again, with an actively managed portfolio, you're not just buying and holding, you're buying into an investment, but then you can potentially sell off a certain investment depending on the overall stock market, on the economy, on different things like that. So again, you're actively managing it, you're making moves within the portfolio. That can be beneficial for people who are older, who are in retirement. And back in going back about 12 years to 2007, at the time in late 2007, the market hit an all-time high. But then what followed was about a year and a half of market downturn. So we almost all remember the recession back in 2008, where from late 2007 to early 2009 and all throughout 2008, the stock market lost over 50%. And if you were allocated all into the stock market, you could have taken a 50% loss or more. I've actually seen people that they had investments at the time where they lost up to 70% depending on how they were allocated. And if you were allocated to 100% stocks during that time, you probably had a loss of right around, again, 50%, maybe a little less, maybe even a little bit more. But it took the market 5 years to recover and get back to where it was in late 2007 before the 2008 recession. Meaning it took until about 2013 to recover and get back to where it was. And the reason why I bring that up is because there's not too many retirees who have the time on their side to wait around for 5 or more years for their money to come back to where it was. So the magnitude of losses can be compounded in addition to that if you're withdrawing the money from the account, which many retirees do. So that's why with an actively risk-managed portfolio, you can go, and if the market starts going down, you might take losses of 5, 10, even 15% in that year. But even a 15% loss is a heck of a lot better than a 50+% loss. So again, with actively managed portfolios, they try and minimize those catastrophic downturns, the downturns in 2008, even in late 2018 when the market lost 20% in the span of 3 months, try and minimize big-time short-term fluctuations, but mainly catastrophic downturns as well. And during that time when the market's going down like it was back in 2008, sure, you might not be making money, but the whole goal is to try and preserve what you've accumulated. Because again, when you're retired, you can't go back and add money to the portfolio. You're taking money out, so you want to make sure that it's actively managed, that you have the ability to sell off a certain investment and go into something more conservative when the market's going down. So when it comes to an actively managed strategy, they work better for the usually the pre-retirees and retirees, whereas buy and hold is usually seen with people who are in their 20s, 30s, and 40s. They're still in their working years and contributing to their retirement accounts.
Okay, that's all the time we have this week. See you later and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.